3 months, 6 months, 12 months. The right answer depends on your specific situation. I'll give you a formula to calculate your exact number. Welcome to Canadian Optimizer, where we empower you with practical financial knowledge. Today, we're tackling one of the most fundamental pillars of financial security, the emergency fund. It's more than just a savings account, it's your personal safety net against life's inevitable curveballs. We'll demystify how much you truly need, specific to your Canadian context and personal circumstances, moving beyond the generic rules of thumb. By the end of this video, you'll have a clear, actionable plan to build or optimize your own financial buffer. Imagine an unexpected car repair, a sudden job loss, or a medical emergency. Without an emergency fund, these events don't just cause stress, they can derail your entire financial future. Many Canadians resort to high-interest credit cards or lines of credit to cover these unforeseen costs, digging themselves into a debt hole that can take years to escape. An emergency fund acts as your financial shock absorber, allowing you to navigate these challenges without incurring debt. It provides invaluable peace of mind, knowing you have a buffer to protect your lifestyle and long-term goals. This isn't about being pessimistic, it's about being prepared and proactive. While the concept of an emergency fund is universal, the Canadian landscape presents its own unique considerations. Our job market, while generally stable, can have regional fluctuations, making job loss a real concern. Although we have universal health care, unexpected dental work, prescription costs not covered by provincial plans, or specialized treatments can still create significant out-of-pocket expenses. Furthermore, the rising cost of living in many Canadian cities means that expenses accumulate quickly, and an emergency fund needs to be robust enough to cover these higher costs. Understanding these specific Canadian nuances helps us tailor your fund to be truly effective. It's critical to distinguish between a true emergency and a desired expense. An emergency is an unforeseen, unavoidable expense that, if not covered, would have significant negative consequences. Think sudden job loss, requiring funds to cover living expenses until new employment is secured. Or an unexpected medical or dental emergency not fully covered by insurance. Essential home repairs, like a leaky roof, or critical car repairs that impact your ability to commute, also qualify. What an emergency fund is not for, however, is a new television, a spontaneous vacation, or holiday shopping. These are planned expenses that should come from regular savings or discretionary income. You've likely heard the common advice, have 3 to 6 months of expenses saved. While a good starting point, this blanket recommendation often falls short because it fails to account for individual circumstances. Someone with a stable government job and no dependents will have vastly different needs than a self-employed individual with a mortgage and a family. Relying solely on a generic rule can leave you either overprepared, with money sitting idle, or dangerously underprepared, facing significant risk. Our goal today is to move past this myth and equip you with the tools to calculate a truly personalized and optimal emergency fund amount. The foundation of your emergency fund calculation begins with understanding your essential monthly expenses. This isn't just about what you spend, it's about what you must spend to maintain your basic living standards. Go through your bank statements and credit card bills for the last few months. Categorize everything: rent/mortgage, utilities, groceries, transportation, essential insurance premiums, and minimum debt payments. Exclude discretionary spending like dining out, entertainment, or subscription services you could cut. This step requires honest self-assessment. What could you not live without for a few months if absolutely necessary? This core number is your absolute minimum monthly need. Next, consider your job stability. Are you in a highly secure field, like a unionized public sector role, or a more volatile industry, such as tech startups or gig economy work? Is your income consistent, or does it fluctuate month to month, like commission-based sales? Self-employed individuals typically face higher income uncertainty and should aim for a larger fund. If you're employed in a sector prone to layoffs or where finding new work takes longer, you'll need more months of expenses saved. This assessment directly impacts how many months you should aim for beyond the bare minimum. A higher risk means a larger buffer is prudent. Your personal health and family situation significantly influence your emergency fund needs. If you or a family member have pre-existing medical conditions that might require unexpected treatment or medication not fully covered by provincial plans or private insurance, you'll need a larger buffer. The number of dependents, children, elderly parents, also plays a crucial role. More people relying on your income means higher essential expenses and a greater need for security. Review your insurance coverage carefully. Identify any gaps that an emergency fund might need to cover. A larger family or higher health risks necessitate a more robust financial safety net. The type of assets you own and your existing debt burden are vital factors. Homeowners, for instance, face potential emergency repair costs like furnace replacements, roof repairs, or plumbing issues that renters do not. If you own an older vehicle, the likelihood of needing significant repairs increases. Conversely, if you have very little debt, you might feel more comfortable with a slightly smaller fund, as your mandatory monthly outflows are lower. However, if you have substantial consumer debt, ensuring you have enough to cover minimum payments during an emergency is paramount to avoid defaulting and damaging your credit. Now, let's bring it all together. Take your calculated essential monthly expenses. Then, adjust the number of months based on your risk factors. If you have high job stability, excellent health benefits, few dependents, and minimal assets, you might be comfortable with 3 to 4 months. If you're self-employed, have health concerns, multiple dependents, or an older home/car, aiming for 6 to 12 months, or even more, is a prudent strategy. The optimal range is therefore not a fixed number, but a spectrum from 3 to 12 plus months of essential expenses, tailored precisely to your unique financial blueprint and risk tolerance. This isn't just about saving, it's about smart, personalized financial planning. Once you know your target, the next crucial step is choosing the right home for your emergency fund. It needs to be easily accessible but separate from your everyday checking account. The ideal solution for most Canadians is a high-interest savings account, HISA. HISAs offer better returns than standard savings accounts, helping your money grow slightly or at least keep pace with inflation, while still being liquid. Avoid locking these funds into GICs or investments that could lose value or be difficult to access quickly without penalty. The goal is safety and liquidity, not aggressive growth. Look for accounts with no monthly fees and instant transfer capabilities. Now, let's talk about building this vital fund. The first and most effective strategy is through diligent budgeting and expense reduction. Start by tracking every dollar you spend for a month or two. This illuminates exactly where your money is going. Then, identify non-essential expenses that can be reduced or eliminated. Can you cut down on subscriptions you rarely use? Cook at home more often. Reevaluate your phone or internet plan. Every dollar saved from your discretionary spending can be redirected straight into your emergency fund. This isn't about deprivation, it's about reallocating resources towards your financial security. While cutting expenses is powerful, increasing your income can accelerate your emergency fund growth significantly. Consider a side hustle. This could be anything from freelancing in your area of expertise, driving for a rideshare service, or even dog walking. Many Canadians have unused items around their homes that could be sold on online marketplaces, providing a quick influx of cash. For those in traditional employment, could you negotiate a raise, take on extra shifts, or pursue a promotion? Even small, consistent increases in income, when fully dedicated to your emergency fund, can make a substantial difference over time, shortening your savings timeline. One of the most powerful strategies for consistent savings is automation. Set up an automatic transfer from your checking account to your high-interest emergency fund account immediately after each payday. Treat this transfer like a non-negotiable bill. Pay yourself first. Even if it's a small amount to start, consistency is paramount. As your income increases or expenses decrease, you can gradually increase the automated transfer amount. By removing the decision-making process, you eliminate the temptation to spend that money elsewhere. This set it and forget it approach ensures steady progress towards your emergency fund goal without constant effort. Once your emergency fund is established, it's crucial to guard it fiercely. Remember our definition of an emergency: unforeseen, unavoidable, and significant. Resist the urge to dip into it for non-emergencies like a great sale, a spontaneous trip, or even small, manageable expenses. Every time you use it for something that isn't a true crisis, you compromise your financial security and undermine the very purpose of the fund. If you do have to use a portion of it for a genuine emergency, make replenishing it your absolute top financial priority immediately afterward. Think of it as a financial first aid kit, to be used only when truly needed. Life happens, and sometimes you will need to tap into your emergency fund. This is precisely what it's there for. But the job isn't done once it's used. The next crucial step is to make rebuilding it your absolute top financial priority. Reevaluate your current budget to see if there are additional temporary cuts you can make to accelerate replenishment. Adjust your automatic transfers to be as aggressive as possible until your fund is back to your optimal target. This process ensures that you remain financially resilient, ready for the next unexpected challenge without having to start from scratch or incur debt. Don't delay, rebuild with urgency. Congratulations, you've built your optimal emergency fund. What's next on your financial journey? With your safety net firmly in place, you can now confidently pursue other financial goals. Prioritize tackling any remaining high-interest debt, such as credit card balances, as this frees up more of your income. Then, shift your focus towards long-term investing for wealth creation. Think TFSAs, RRSPs, or non-registered accounts, tailored to your risk tolerance and goals. Start planning for significant life milestones like a down payment on a home, retirement, or your children's education. Your emergency fund has provided the essential bedrock for all future financial growth and aspirations. Let's recap the core insights from today. First, your emergency fund isn't a one-size-fits-all solution. It requires a personalized calculation based on your essential expenses, job stability, health, and assets. Second, keep it in an easily accessible, high-interest savings account separate from daily spending. Third, make building it effortless by automating transfers and actively reducing expenses or boosting income. Finally, protect your fund rigorously, using it only for true emergencies, and prioritize rebuilding it immediately if you need to tap into it. This proactive approach will transform your financial security and peace of mind. The journey to financial security begins with a single step. Don't be overwhelmed by the total number. Start small, be consistent, and watch your fund grow. Remember to review your emergency fund needs annually, or whenever a major life event occurs, such as a new job, a new family member, or a change in your health. An optimized emergency fund is truly the cornerstone of a resilient financial life, providing not just protection, but profound peace of mind. Take control of your financial future, starting today. Thank you for joining us on Canadian Optimizer. Thank you for watching. If you liked this video, please like and subscribe.